Greetings and a warm welcome to all distinguished delegates, industry leaders, and colleagues. It's a privilege to join you at the 18th Global Supply Chain and Logistics Summit here in Dubai, at a moment where global trade routes are being tested in ways few could have imagined just a few years ago. At the outset, I take this opportunity to thank Mr. Shashi Shekhar, President of Supply Chain Logistics Group, and Ms. Kanchan Vora, Director of SCLG, for organizing this yet amazing annual event and having opportunities to share industry trends, best practices, and constructively network with industry participants who have come here across the globe. Today's presentation, Black Swan in Red Sea, Mind the Risks and Insurance Gaps, examines a region that has become the epicenter of geopolitical strain, maritime disruption, and insurance uncertainty. More than 190 vessels have been targeted since October 2023, and all three of the world's most critical maritime choke points have experienced heightened threat levels and disruptions in the Red Sea, impacting over $1 trillion in trade flows. We are witnessing the rise of shadow fleets, uninsured vessels, GPS spoofing, sanctions driven opacity, and an escalation of war risk exposures that have fundamentally altered the operating landscape for cargo owners, charterers, insurers, and supply chain participants. In this environment, the traditional assumptions of all risks insurance cover, standard protection, or routine voyage planning no longer hold. My goal today is straightforward: to provide a clear, practical, and prudential understanding of the risks we face, the insurance gaps that are often overlooked, and the concrete learning every cargo owner, trader, charterer, broker, and financier must adopt to remain protected in this VUCA world. Thank you for being here, and I invite you to engage deeply, question assumptions, and evaluate your own exposure as we navigate this critical topic. I'm H.C. Barke, President and CEO of Prudence, and it's my privilege to be here with fellow leaders in global logistics and supply chain management. Over the past 3 decades, I have led risk, underwriting, and trade finance advisory functions across 4 continents, working with corporations, navigating geopolitical shocks, marine casualties, sanctions, and insurance complexities. My academic journey spans Wharton, Harvard Business School, and Cornell, complemented by legal credentials, LLB, and industry credentials such as CPCU, ACII, AIC, FIII, AIRM, and ARE. The insights I'll share today come directly from real cases: cargo seizures, shadow fleet exposures, war risk claims, and supply chain disruptions that I've handled firsthand. My intention is simple: to give you clarity, preparedness, and actionable prudential learning in a rapidly evolving landscape. Before we dive into the Red Sea disruptions, it's important to ground ourselves in the scale of what is at stake. In 2024, global trade reached 33 trillion US dollars according to the World Trade Organization. Of this, 24.43 trillion came from merchandise trade and 8.69 came from services, both showing a year-on-year growth despite geopolitical instability. What's critical for this room to recognize is that approximately 90% of global merchandise trade moves by sea, which means maritime corridors are the arteries of the world economy. Nearly 85% of this global trade is conducted on credit terms or unsecured terms. And for most companies, especially small and medium enterprises, trade receivables accounts for a whopping 45 or up to 65% of the total current assets. This means a single disruption in shipping lanes or maritime risk zones doesn't just delay cargo, it directly impacts liquidity, working capital, and credit exposure across supply chains. So, when we talk about choke points in the Red Sea, the Strait of Hormuz, or the Suez Canal, we are not talking about isolated incidents. We are talking about threats that can ripple across trillions of dollars of trade and balance sheets worldwide. This sets the foundation for why the Red Sea events are not just maritime issues, they are global economic and credit risk issues. Here is a roadmap for today's discussion. We'll keep the discussion focused, practical, and grounded in real cases. First, we'll look at the risks in the Red Sea and the rise of the shadow fleet, understanding how geopolitical tensions, attacks on vessels, deceptive shipping practices, and war risk navigation zones are reshaping maritime exposure. This context is essential because these risks are no longer theoretical, they are active and escalating. Second, we'll examine the insurance gaps. Many cargo owners, charterers, and even large multinationals assume they are fully protected. But as we'll see, standard cargo hull, P&I, and war risk policies often contain exclusions or sanctions, delay, confiscation, cyber threats, and high risk navigation zones, which can leave companies unexpectedly uninsured. And finally, we'll move to prudential learnings. Based on real incidents, claims, and global disruptions, we'll discuss the practical steps every business organization should take, spanning verifying vessel class and P&I entry, confirming war risk insurance coverage, understanding sanctions exposure, protecting credit receivables, and ensuring supply chain resilience and continuity. The goal is to leave you with a clear, actionable insights you can implement immediately. With that structure in mind, let's move into the first section, the evolving risk landscape in the Red Sea. Before we discuss the individual incidents, it is important to understand a strategic geography that is shaping today's disruptions. The Middle East conflict involving Israel, Palestine, and Iran has already costed the region over 67 billion US dollars in economic losses, and its effects extend far beyond land borders. It has triggered a period of heightened maritime insecurity, affecting all three critical choke points that appear on this map, namely the Strait of Hormuz, Bab-el-Mandeb, and Suez Canal. The Strait of Hormuz, through which 20% of the world oil and LNG and 80% of the Gulf energy exports flow. Bab-el-Mandeb, the narrow Gate of Tears, a 32-kilometer wide corridor that connects the Red Sea to the Indian Ocean and has become the focal point of Houthi attacks. And finally, the Suez Canal, carrying 12% of global trade, 30% of world container traffic, and 8% of global oil and LNG. The Strait of Hormuz, you have 33,000 ships passing every year. And through the Suez Canal, we are approximately 26,500 ships passing every year. These are not isolated channels. Together, they form the arterial system of energy flows connecting the Gulf to the Europe, the Mediterranean, and global markets. More than 50% of the world's seaborne oil trade passes through these three important gateways, or also the choke points. With all three choke points under simultaneous pressure from missile attacks, drone strikes, vessel seizures, and political escalations, the result is a systemic threat to global supply chains, especially for the Middle East and Gulf Cooperation Council economies that rely heavily on energy exports and import routes for food, equipment, and industrial goods. What we are seeing today is unprecedented. All three choke points strained at the same time, creating cascading disruptions, longer transit times, higher freight rates, elevated war risk insurance premiums, rerouting shipments via the Cape of Good Hope, and tightening liquidity for traders exposed to delay and credit risk. This slide sets the context for why the risks in the Red Sea are not isolated maritime events. They represent a regional, and global supply chain challenge driven by geopolitical conflicts and concentrated shipping dependencies. Building on the choke point risks we just discussed, we now zoom in on Bab-el-Mandeb, which has become the epicenter of maritime insecurity in the region. Since October 2023, over 190 commercial vessels transiting the Red Sea have been targeted with missiles, drones, and explosive boats launched by Houthi. This is not a random pattern. It reflects a sustained strategic campaign to disrupt global shipping and pressure the international community. Bab-el-Mandeb, shown here, is a narrow 32-kilometer, that is 20-mile corridor, and its geography amplifies the risks. Vessels have extremely limited room for evasive maneuvering, which is why Houthi attacks have been so operationally effective. These incidents have affected container ships, bulk carriers, tankers, and even LNG vessels, forcing global shipping lines to reroute, in some cases, thousands of miles around the Cape of Good Hope. The cost implications are enormous: higher fuel consumption, multi week voyage delays, increased war risk insurance premiums, and tightening liquidity due to delayed cargo delivery and trade receivables. Importantly, these attacks are not only a security problem, they directly challenge the assumptions companies make about insurance coverage, especially regarding war risks, sanctions, navigation limits, and delay exclusions. This slide reinforces the reality that the Red Sea is now a high risk navigation zone and the threat environment is ongoing, not temporary, requiring cargo owners, charterers, insurers, and traders to adapt their risk strategies accordingly. Having seen the scale of Houthi attacks in the Red Sea, this slide reminds us that the threat is not limited to one actor or one corridor. The Strait of Hormuz and the Gulf of Oman have been equally volatile, with Iran and the Iran Revolutionary Guards carrying out a series of vessel seizures, boardings, and kinetic attacks since 2019. What you see on this slide is only a representative list, but it highlights three important realities. First, these incidents target commercial vessels, not military assets, including Suezmax and Aframax tankers, product carriers, and container ships. Events such as the Advantage Suite seizure in April 2023 or the St. Nicholas incident demonstrates how quickly an ordinary voyage can become an international crisis. Second, these seizures often involve vessels carrying high valued cargoes, crude oil, refined products, petrochemicals, etc., creating substantial exposure for cargo owners, charterers, and financiers. In many cases, the cargo is offloaded, detained, or expropriated, which leads to complex disputes about whether the loss is classified as war, terrorism, confiscation, or political risk related, a distinction with major implications for the insurance recovery. And finally, these actions directly affect the Strait of Hormuz, through which nearly 20% of the global oil and LNG shipments pass. Even a single detention can elevate freight rates, increase war risk insurance premiums, and trigger a cascade of contractual, credit, and supply chain disruptions across the Gulf and beyond. The attacks in the Red Sea and the broader Middle East are no longer isolated maritime security events. They have resulted in over 1 trillion in trade disruption, affecting shipping lines, energy producers, commodity traders, and insurers worldwide. Let me briefly highlight the cases shown on this slide. First is MV Rubymar, hit by Houthi missiles in February 2024 while transiting Bab-el-Mandeb. This vessel eventually sank, spilling fuel and creating a 29-kilometer oil slick and leaving behind 41,000 metric tons of fertilizer at the bottom of a major shipping corridor. The environmental risk, navigation hazard, and insurance complications are still unfolding. The next is MSC Aries. seized by Iranian Revolutionary Guards in April 2024 in the Strait of Hormuz. The single detention triggered immediate rerouting decisions by multiple shipping lines and further increased the war risk insurance premiums overnight. The third case is of MV Soul Union, which carried 1 million barrels of oil when it came under a multi stage attack involving small arm fires, projectiles, and a drone boat. Incidents like these directly threaten the world energy flows. And finally, we have Chevron's $57 million denied insurance claim. Insurers ruled that the seizure of their cargo by Iran did not constitute a warlike operation. This case is a powerful reminder that not all geopolitical losses are covered even under ICCA or Institute War and SRCC risk insurance policies. The point of this slide is simple but critical. Every new attack, seizure, or detention creates knock on effects across freight rates, supply chain timelines, trade finance, receivables recovery, and insurance liability. And these are not one off events, they form a pattern of systemic disruption that global businesses must build into their risk and insurance planning. Beyond missile attacks and vessel seizures, we are also now witnessing a new and rapidly growing risk category in the Red Sea area, especially. That is GPS jamming and GPS spoofing. This slide highlights the case of MSC Antonia, which ran aground near Jeddah, Saudi Arabia, after its navigational systems were compromised. Investigations confirmed that GPS signal interference caused the vessel to misread its position, leading to a grounding incident that could have resulted in severe cargo loss, hull damage, and major port congestion. This is important for three reasons. First, it shows that the threat landscape has expanded from physical attacks to electronic and cyber disruptions. Ships today rely heavily on GPS for navigation, collision avoidance, and route planning. Spoofing can literally redirect a vessel into a hazardous waters without the crew realizing it. Secondly, cyber interference does not always fall under traditional war risk, hull, or cargo insurance coverage. Many policies exclude cyber events unless specifically endorsed, so companies may face losses that fall outside the scope of cargo insurance coverage, meaning no claim payout. And finally, GPS manipulation can cause cascading operational cost, grounding delays, salvage operations, port shutdowns, deviation penalties, charter party disputes, and cargo deterioration for time sensitive cargo goods. The key takeaway here is that marine cyber risk is no longer hypothetical. It is now an active threat in high risk zones, and organizations must review both their voyage planning and their cyber risk insurance provisions to ensure that they are well protected. Let me now introduce you to one of the most significant and least understood threats in the global shipping today, the shadow fleet. A shadow ship is a vessel that deliberately hides its identity, ownership, location, or cargo to evade sanctions, regulatory scrutiny, and insurance controls. These ships routinely turn off AIS, falsify tracking data, use shell companies, forge documents, and operate outside the mainstream maritime ecosystem. Now, why does this matter? Because the shadow fleet is no longer a small, marginal segment. It has grown into a large, parallel shipping network driven by sanctions on Russia, Iran, and Venezuela. These vessels move crude oil, refined products, and sometimes high risk or illicit cargoes, and they do so with minimal transparency and minimal oversight. As of September 2025, the shadow fleet is estimated at over 3,300 vessels. To put that into perspective, this represents 17% of the world's in service oil and product tanker fleet, nearly one in every six tankers globally. Even more concerning is the composition of this fleet. 940 vessels fall into Tier 1 and Tier 2 dark fleet categories, meaning they use deceptive shipping practices such as AI's manipulation, false documentation, shell company structures, and concealed beneficial ownership. This segment alone has grown 45% since May 2024, reflecting how quickly sanctions driven trades are expanding. Behind these figures are powerful economic incentives, with sanctioned shipments commanding premium freight rates, often double the normal levels. Many operators are tempted to enter this grey market despite its operational and legal risks. The practical implication is this: the shadow fleet can no longer be viewed as an outlier. It is now a parallel global logistics system operating with minimal oversights, high accident probability, and little to no valid insurance cover. Thus, the shadow fleet is not a fringe problem, it is a systemic risk embedded in today's global supply chains. This chart breaks down the explosive growth trajectory of the shadow fleet across key vessel categories. The numbers here tell a very clear story. This ecosystem is expanding at an alarming pace. We see three striking percentage increases. Tier 1, 92% growth, spanning 520 ships. Tier 2 sanctioned vessels with a 31% growth, spanning 420 ships. And most importantly, the Tier 3 with a whopping 164% growth, spanning 2,217 ships. This is the most alarming increase. Vessels engaging in deceptive, high risk practices such as continuous AIS manipulation, forged paperwork, false flagging, and questionable classification and PNI arraignment. This category represents the backbone of the dark fleet and poses the highest operational, environmental, and sanctions risk. One of the most dangerous characteristics of the shadow fleet is its age. More than 60% of the shadow fleet vessels are 20 years or older. In commercial shipping, once a tanker crosses 15 to 20 years of age, the operational risk profile increases dramatically. Now, why is this a critical issue? Firstly, aging ships have a far higher likelihood of mechanical failure and breakdowns. Secondly, these vessels often operate outside the oversight of International Association of Classification Societies and reputable international group of protection and indemnity clubs. Without legitimate inspections, hull checks, or machinery audits, their seaworthiness is questionable at best. And thirdly, because many shadow vessels are engaged in sanction evasion trade, operators may deliberately avoid ports where inspections are mandatory. This means equipment problems go unreported and uncorrected until an accident happens. Another more serious and consequential aspects of the shadow fleet is that most of the vessels are not insured, especially not insured by International Group of Protection and Indemnity Clubs or A-rated international insurers. This point cannot be overstated. The vast majority of the shadow vessels lack proper P&I insurance, pollution liability insurance, charters liability insurance, hull and machinery insurance from credible insurers and reinsurers. This is because IGP&I clubs and S&P and above rated insurers will not provide cover for such shadow vessels which evade sanctions. Now, why is it so dangerous? First, if an uninsured shadow vessel causes a collision, spill, grounding, or environmental disaster, there is no reliable insurer to pay for cleanup, third party claims, or cargo losses. The financial burden falls on cargo owners, charterers, financiers, port authorities, and the governments. Secondly, trading with an uninsured or improperly insured vessel can invalidate the insurance of legitimate parties. Even innocent cargo owners may find their cargo claims denied because the vessel itself was operating without a valid insurance cover. And thirdly, the environmental and safety implications are severe. An uninsured vessel involved in a spill or a sinking in Red Sea, Hormuz, or the Indian Ocean would create a crisis with no compensation mechanism, leaving multi-million-dollar liabilities unresolved. The real world dangers created by the shadow fleet goes beyond sanctions, compliance, or insurance gaps. These vessels pose a direct environmental and maritime safety threat to the global shipping routes. Because many shadow vessels are old, poorly maintained, uninsured or improperly insured, and operated under opaque ownerships, they pose significant threats to the maritime navigation. And because they are more prone to mechanical failures, breakdowns, loss of steerage, fires, groundings, and major pollution events. We have seen this repeatedly across high traffic corridors such as the Red Sea, Gulf of Oman, and Southeast Asian waters. When a vessel with no proper P&I cover or pollution liability suffers a spill or collision, there is no guaranteed compensation mechanism for a cleanup or third party losses. We can see from this notable incidents why the shadow fleet is not just a compliance problem, it is a major operational and safety threat to global shipping. Since February 2022, we have recorded more than 50 incidents involving shadow vessels. These are not minor faults, they include explosions, collisions, fires, grounding, oil spill, and engine failures. The recent notable incident involving the vessel Adeline and Front Eagle collision on June 2025 is important. There is a pictorial depiction of the collision which happened between these two vessels. Let's now look at one of the most serious incidents. Yeah. Now, this collision between the vessel Adeline and the Front Eagle, which took place on 17th of June 2025 at the eastern entrance to the Strait of Hormuz and just 50 nautical miles off the coast of Fujairah, United Arab Emirates. This incident is significant for several reasons. First, the collision involved a very large crude carrier or VLCC, the Front Eagle, a fully legitimate Liberia flag tanker managed by a reputable operator. A VLCC normally carries up to 2 million barrels of crude, so any accident of this scale poses enormous spill and safety risks. Second, the other vessel, the Adeline, is a part of a dark fleet operating with a concealed ownership, questionable documentation, and no valid insurance. Authorities could not obtain proper communication from the owners, highlighting how opaque these vessels are. And thirdly, the collision demonstrates a structural systemic risk. A single dark fleet tanker operating without oversight can collide with a fully insured vessel and create a catastrophic uninsured exposure for everyone involved. Consider the implications. If the Front Eagle had suffered a major rupture, the environment cost would have been massive. The Adeline's lack of P&I cover means there would be no insurer to pay for cleanup, third party claims, cargo loss, salvage, or damage to Front Eagle, and the liability would fall into legal limbo. Cargo owners, charterers, ports, and coastal states would have no financial recourse. And fourth, this happened at the mouth of the Strait of Hormuz, one of the most vital energy corridors in the world. Even a short disruption impacts global oil prices, freight rates, and insurance premium. This incident is a perfect example of how the shadow fleet creates asymmetric risk. A high value, fully insured tanker can be put in jeopardy by a low value, uninsured, sanctions evading vessel with no accountability. It underscores why due diligence on vessel identity, class, P&I entry, AIS behavior, and ownership is absolutely essential in today's maritime environment. If the shadow fleet is so risky, why do charterers and some owners still engage with it? The answer is straightforward: money. Freight rates for sanctioned or semi sanctioned trades are often double the normal levels, sometimes even higher. For certain operators, the financial incentive to take a subcharter or an indirect fixture in this grey market can be extremely tempting. But let me also make it clear that while the short term earnings may look attractive, the risk exposure for both charterers and owners is enormous. Let's Now look at the specific risks faced by charterers when they engage, knowingly or unknowingly, with the dark fleet. And this is important because charterers often assume they are insulated if they rely on contractual clauses or agents. In reality, the exposure is direct and severe. Let's break down the major risks. The first is secondary sanctions. For charterers, this is the most immediate and the most dangerous threat. The United States applies secondary sanctions even if the charterer has no US operation or US cargo link. A single voyage involving a sanctioned vessel or cargo with misrepresented origin can trigger sanctions listing even when due diligence was attempted. This risk is amplified because dark fleet ships frequently use forged documents. The second risk is shipping sanctioned cargo by mistake. Deceptive practices in the dark fleet means charterers may unknowingly transport Russian, Iranian, or Venezuelan cargo that is disguised or relabeled. A reliance on falsified documentation can expose the charterer to sanctions penalties, regulatory investigations, and criminal liability in some jurisdictions. Thirdly, the risk is insurance invalidation. Once sanctions are suspected or confirmed, P&I clubs and insurers may all withdraw cover, refuse to pay claim, or even void the policy ab initio with a retrospective effect. This leaves the charterer responsible for cargo loss, pollution liability, and third party claims. The fourth risk is costly commercial disputes. Even if the charter is not sanctioned, involvement with a dark fleet vessel often leads to disputes over deviation, debt freight, demurrage, off-hire periods, and cancellation triggers under sanctions clauses. These disputes are rarely straightforward and often turn into multi-million dollar legal battles. The fifth risk is refusal by the banks, ports, and counterparties. Once a vessel is flagged as suspicious, banks may refuse to process payments, ports may deny entry, surveyors may decline to board, and counterparties may suspend cooperation. This can freeze the charter's entire operation with immediate financial impact. Another risk is reputational risk. Even being linked indirectly to a dark fleet vessel can damage a charterer's global reputation, affecting access to financing, future chartering opportunities, and long term customer trust. And finally, the criminal risk. In extreme cases, regulators may pursue criminal action even if the charter is deemed to have facilitated sanctions evasion. Thus, the financial rewards of dark fleet fixtures are far smaller than the legal, compliance, and insurance risks they trigger. The risks faced by vessel owners who participate in or even appear to participate in dark fleet or sanction linked operations are equally severe to those faced by charterers. Let's break them down. The first risk is the loss of insurance cover. This is the most immediate and financially devastating risk for the owners. P&I clubs, especially international group of P&I clubs, are extremely sensitive to sanctions compliance. If a vessel is suspected of carrying sanctioned cargo, conducting deceptive AIS practices, or been involved in irregular trades, the club can withdraw P&I cover immediately. And without P&I cover, the vessel is essentially illegal to operate in most ports. A single uninsured incident, such as a collision, pollution event, cargo damage, or injury, can bankrupt an owner. The second risk is that the financiers become wary. Banks and financiers closely track vessel trading patterns. If a vessel is connected to dark fleet activity, lenders may refuse to refinance loans, freeze credit lines, or decline to support fleet expansion. And you also have the risk of reputation damage. Owners may think that the dark fleet is hidden, but the maritime community is tightly connected. Once an owner is linked to an opaque operation or sanctions evasion voyages, charterers stop fixing their ships, brokers avoid recommending them, and ports subject them to heightened scrutiny. Rebuilding trust can take years, if ever. The next risk is detention by port state authorities. Many ports are now aggressively enforcing sanctions compliance. A vessel suspected of evasive trading may be boarded, detained, inspected in detail, and subjected to paperwork audits and also delayed for days or weeks. Detentions can trigger cascading financial losses of higher claims, cargo detention, and penalties. Another risk is of fines, delays, and cargo owner claim. If a vessel becomes embroiled in sanctions or compliance issue mid voyage, cargo owners can claim damages, charterers can claim off hire or deviation, insurers may deny claims, and courts may impose substantial fines. Finally, environmental and liability risk exposure. If a vessel involved in shadow operation causes a spill, fire, grounding, or collision, there is no P&I cover to protect the owner. All liabilities fall directly on the owner's entity, which in many cases cannot absorb the losses. So, the key message here is the risk for both the charterers and owners are systemic, escalating, and far outweigh any temporary commercial advantage. Maritime mutual and sanctioned vessels, a global compliance alarm. We now highlight a major development that shook the maritime insurance world: the Reuters investigation into maritime mutual insurance and its role in insuring vessels involved in sanctioned Russian and Iranian oil trades. This investigation revealed something unprecedented. Maritime Mutual provided cover to 97 tankers under sanctions, including 48 vessels that were actively sanctioned on the very day they were carrying Maritime Mutual insurance. Now, why is this significant? First, it exposes a parallel ecosystem of insurance. These vessels were able to bypass the mainstream compliance checks by relying on an insurer outside an international group of P&I system. This allowed sanctioned cargoes, including Russian and Iranian oil, to move freely than regulators believed. Second, it highlighted a massive due diligence blind spot for charterers, traders, and even some banks, which were relying on documentation from Maritime Mutual. Thirdly, it triggered immediate regulatory scrutiny following Reuters' report. Fourthly, it confirmed how easily sanctions can be circumvented. This investigation showed that even when vessels are officially sanctioned, they can still operate if counterparties fail to verify the legitimacy of their P&I cover. And finally, it reinforced the key message: verify insurance at source. Cargo owners, charterers, and financiers must now go beyond simply checking whether a vessel has insurance. They must confirm that the insurer is International Group of Protection and Indemnity Club recognized, properly rated and reputed, and compliant with sanction laws. On 20th October 2025, Maritime Mutual's offices were raided by the authorities. This was not a routine audit, it was a full scale enforcement action triggered by the evidence that the insurer had been providing cover to dozens of sanctioned Iranian and Russian tankers, including vessels that were openly blacklisted by the Western government. So, check: are you insured with Maritime Mutual? After the Reuters investigation and the regulatory raid on Maritime Mutual, every company involved in maritime trade, cargo owners, charterers, ship owners, brokers, financiers, must now ask a very basic but critical question: are we insured with Maritime Mutual, directly or indirectly? And if the answer is yes, it is recommended to consult your lawyers and your insurance brokers without much delay. Why? Because insurance certificates for Maritime Mutual may not be recognized by International Group of Protection and Indemnity Clubs, major ports, coastal authorities, counterparties, banks and financiers, and international regulatory bodies. This means company relying on that cover may have been operating with invalid or non-compliant insurance, exposing them to uninsured pollution liability, uninsured cargo claims, uninsured collision or wreck removal costs, sanctions risk, contract breaches, and potential regulatory inquiries. This is a wake up call. Due diligence must now include verifying the insurer, not just verifying that a certificate exists. The incidents we have been discussing: Houthi attacks, Iranian vessel seizures, GPS spoofing, shadow fleet casualties, are not random maritime events. They are a direct consequence of deepening geopolitical tensions across the Middle East, Europe, and major energy corridors. And now, a pertinent question is: Are you insured for such geopolitical risks? Five insurance covers come in play whenever a maritime incident happens. First, marine cargo insurance, which insures the cargo transported by the vessel. Second is marine hull and marine hull war risk insurance. Third is a protection and indemnity insurance, which covers maritime liabilities involved in the vessel navigation. Fourth is a charterer's liability insurance, especially where bulk and break bulk cargo shipments are involved. And lastly, freight services and liability insurance, which provides protection to freight forwarders, NVOCC operators, logistics service providers, and intermediaries. In today's environment, they are increasingly exposed to documentation risk, sanction screening failures, cargo delays, and also alleged misrepresentations in bills of lading or booking processes. Now let's look at high risk navigational area exclusion. And you should mind the gap. This is one of the most important insurance slides in the entire presentation because it explains why so many recent maritime losses have been resulted in denied claims. This slide highlights that cargo insurance, hull and machinery insurance, and P&I insurance all contain strict navigational limits, especially for high risk zones which are excluded, such as Ukraine and Black Sea region, Russian territorial waters, the Sea of Azov, and now since January 2024, the Red Sea, Indian Ocean parts, Gulf of Aden, and Southern Red Sea, as reflected in this particular slide. These are officially designated uninsured navigational areas. That is, no insurance cover or no insurance protection is offered in case a disaster happens in these excluded high risk navigational areas. Another two important exclusions are the JCC sanction limitation and exclusion clause and the delay exclusion under institute clauses. Now, the sanctions limitation and exclusion clause states that no insurer is obligated or obliged to pay any claim if doing so would expose the insurer to sanctions under United Nations, European Union, United Kingdom, or United States laws. This means that even if the loss itself is legitimate, for example, a missile hit or a vessel seizure, the insurer can refuse the claim if the voyage, cargo, or vessel has any connection to sanctioned countries, sanctioned entities, sanctioned owners or charterers, sanctioned cargo sources, deceptive routing, or forged original documentation. In simple terms, if sanctions touch the voyage in any way, the insurers can walk away and decline the claim. The second is a delay exclusion under Institute Cargo Clause A, War, and SRCC clauses. Loss, damage, or expense caused by delay, even if the delay was caused by an insured risk, is specifically excluded under the Institute clauses. Now, this is extremely critical. So, if a cargo gets deteriorated or spoiled, or if the market opportunities are missed due to late deliveries or delays, all the financial losses or any damage to the cargo due to such time span involving deterioration, spoilage, etc., are specifically excluded from the scope of marine cargo insurance. Now, let's look at four important case studies that showcase how the insurance gaps we have been discussing actually play out in the real world. Each of these four cases represents a different facet of today's risk landscape: uninsured voyages, war risk gaps, sanctions compliance, cargo claims denial, and delay exclusions. These case studies show that the gaps we discussed are not theoretical. They are causing real losses to major companies, ship owners, charterers, and cargo interests. Now let's walk through them one by one. The first case study is of vessel Advantage Suite, where cargo confiscation claim was denied by the cargo insurer. The Advantage Suite, a Marshall Island flagged tanker, was chartered by Chevron. In April 2023, the vessel was seized by Iranian forces in the Gulf of Oman following an alleged collision incident. A year later, in March 2024, an Iranian court ordered the seizure of the cargo valued at approximately 57 million US dollars. After the Iranian Navy seized the tanker and confiscated its crude oil cargo, Chevron filed an insurance claim for US dollar 57 million under both their marine cargo insurance and their war risk insurance. But all three insurers, Zurich American, Liberty Mutual, and Great American, rejected this claim. Now, why insurers defended the claim denial in the court? Their reasoning reveals how insurers interpret geopolitical events in today's environment. The first reason was, well, this was not a warlike operation. The insurers argued that Iran's action, even though they involved military boarding, did not fall under the definitions of war, hostilities, or warlike operations. Instead, they classified the seizure as government action, which is excluded under war risk insurance policies. This interpretation is legally sound under most policy wordings and it is becoming more common. The second reason was confiscation equals to political risk, not cargo or war risk. The insurers argued that because the cargo was seized and expropriated by a sovereign government, the loss fell under the category of confiscation, which is covered only under political risk insurance, that is PRI, not a marine cargo or war risk insurance policies offered under ICCA, war, or SRCC clauses. Chevron did not have political risk insurance for this voyage, therefore, insurers had no obligation to pay. The third reason was sanctions exposure prevents payment. Several Western governments sanctioned Iranian military entities. Paying a claim arising from an Iranian seizure could expose the insurers themselves to secondary sanctions. Under the Joint Cargo Committee's Sanctions Limitation and Exclusion Clause, insurers are legally entitled to decline any claim if paying it would violate sanctions. This provided an additional layer of justification for the denial by the insurers. Fourthly, no physical damage to cargo. Under certain cargo insurance policy forms, detention or seizure of a cargo does not count as physical loss or damage. Since the oil was taken but not physically damaged, cargo insurance coverage was not triggered. So the key takeaway from the slide is that it reinforces a critical message. In today's geopolitical climate, cargo owners cannot rely solely on cargo or war risk insurance for protection. Events involving government seizure, expropriation, or sanctions exposure require political risk insurance, which is an optional and must be purchased separately. Chevron's loss shows that even the largest and most sophisticated companies can suffer multi-million-dollar uninsured losses when the distinctions between war, seizure, and sanctions become blurred. Now let's look at the second interesting case involving shipment of fertilizer cargo on the vessel MV Rubymar. In this case, the shipper was Madain, Saudi Arabia, a major global fertilizer and mining company. The cargo comprised of 21,000 metric tons of fertilizer. The voyage was from Saudi Arabia to Bulgaria. Now, what is interesting that before the voyage began, the lead cargo underwriter or the lead cargo insurer of Madain refused to approve the vessel MV Rubymar under its marine cargo open cover policy. That is, the vessel was declined or disapproved by the cargo insurance by the cargo insurer for cargo insurance coverage because the vessel was not classed by International Association of Classification Societies, nor was it entered into with an international group of protection and indemnity club. Now, this was a crucial red flag. When an experienced marine underwriter disapproves a specific vessel, it is a signal that the ship may be too old, insufficiently classed, a high-risk trading pattern, or operating in an excluded navigational zone. Now, instead of prudently changing the vessel to an insurer-approved one, Madain instead changed the Incoterms of Trade from CIF to FOB. Now, this decision to change Incoterms shifted the risk and optional responsibility for selecting the vessel, managing route exposure, and arranging marine cargo and war risk insurance from the seller, Madain, to the buyer. On 18 February 2024, tragedy struck. While transiting the Bab-el-Mandeb Strait, the Rubymar was struck by Houthi missiles. The vessel suffered severe structural damage, began taking on water, and ultimately sank on 2nd March 2024, just 2 weeks later. Rubymar, pollution, environmental risk, and liability gaps. This Rubymar sinking incident became a major environmental and insurance challenge. After being hit by Houthi missiles and sinking in early March 2024, the Rubymar created two critical hazards. First, a 29-kilometer fuel slick. This posed immediate threats to marine life, coastal ecosystems, passing vessels, and fishing communities. Usually, pollution from tankers is compensated through International Oil Pollution Compensation Fund (IOPC), but here is a problem. IOPC funds do not apply because Rubymar was a bulk carrier and not an oil tanker. Third is that cargo as an environmental threat. The 21,000 metric tons of fertilizer also created a second layer of risk. While not a traditional pollutant, in concentrated quantity, it can disrupt maritime ecosystems, trigger algal blooms, cause oxidant depletion, and endanger regional fisheries. Liability disputes due to insurance limitation. Now, because war risk insurance and P&I cover extensions were uncertain or disputed, liability allocation became unclear. Who pays for cleanup? Who compensates third parties? Who is responsible for environmental restoration? Is the owner even financially capable? Will insurers honor any part of the claim? These questions remain open, creating long-term uncertainty. Let us now look deeper into the structural and insurance failure issues involving Rubymar incident. Here are the key points. First is an extremely fragmented ownership structure of the vessel. Rubymar's ownership and management structure was spread across multiple jurisdictions. Owner, a Lebanese registered company incorporated in Marshall Islands. UBO, that is Ultimate Beneficial Owner, a Lebanese national. Flag State, Belize. ISM Manager, GMS Ship Management, a Honduras registered company but operating from Lebanon. This kind of multi-layered cross-jurisdictional setup is common among high-risk, lower-tier vessels, and it makes liability tracing, legal recovery, regulatory oversight, and insurer accountability much more difficult. The second important point is the protection and indemnity insurance cover through Thomas Miller Specialty. The vessel reportedly had P&I cover from Thomas Miller Specialty, a commercial managing general agent, not an international group of P&I club. Now, this distinction does matter because IGP&I clubs provide strong international spill and liability protection. Commercial non-IG insurers may have narrower cover, limited financial strength, or restricted war risk extensions. This already placed Rubymar outside the mainstream, highly reliable liability ecosystem. And finally, third is a dispute over war risk coverage. According to the owner's lawyer, the Rubymar's operator believed that basic war risk cover was included under their P&I arrangements. But Thomas Miller disagreed. And here is the critical detail. On 13 February 2024, just days before the attack, Thomas Miller informed all assureds, that is policyholders, that the reinsurers could no longer support war risk exposure within the Indian Ocean, Gulf of Aden, Southern Red Sea. As a result, coverage for war risk was withdrawn effective 20th February 2024. Rubymar was attacked on 18 February 2024, 2 days before the cutoff, but war risk protection was already in question, under dispute, and possibly excluded based on reinsurers' withdrawal. Another challenge was because the war risk extensions were either withdrawn, disputed, or insufficiently documented, the vessel was effectively navigating a high-risk war zone without confirmed war cover. This left multiple parties exposed: the ship owner, the cargo owner, the charterer, the port authorities, and potentially even coastal governments. When a vessel is attacked in a conflict zone without verified war risk insurance, there is no clear insurer to pay liabilities, and the result is a perfect insurance failure scenario. This case illustrates the core message of this presentation. In high risk waters, assumptions about insurance are dangerous. Coverage must be confirmed in writing, or the consequences can be catastrophic. Now, let's look at the third interesting case involving vessel Eternity Sea that suffered a catastrophic incident in Red Sea, but with a crucial difference. Now, this vessel Eternity Sea was an International Association of Classification Society classed vessel and entered into with IGPNI Club, that is the London PNI Club, which is a member of International Group of PNI Clubs. However, vessels planning to enter water designated as war risk area by Joint War Risk Committee must inform their marine hull and machinery plus marine war insurers in advance. The insurers have their full discretion to accept the specific voyage at additional premium or to simply decline the insurance cover. In the case of Eternity Sea, the insurer, Travelers, declined war risk cover for this high risk voyage involving Red Sea. The vessel sank after being attacked by Houthi forces while transiting the Red Sea on July 9, 2025. The vessel was worth approximately $15 to $20 million and was a total loss. With no war cover approved, the owner had to absorb the hull loss, salvage obligations, pollution liability, and the wreck removal exposure. So, the key message here is Eternity Sea is an ultimate evidence that when insurers refuse insurance cover for any high risk navigational areas, the owner and charterer must not proceed through such high risk areas, ignoring their insurer's advice, or the consequences may be catastrophic and unrecoverable. After the Eternity Sea sinking incident, the war risk insurance premium for Red Sea voyages spiked from 0.3% to as high as 1% of the ship's value, and that's just for one single trip. Thus, for a standard cargo vessel worth $100 million, this could mean an additional insurance premium up to $1 million per trip, lasting up to 7 days approximately. Now, let's look at the last case study on vessel MV Ever Given, and it's a delay exclusion in action from an insurance perspective. This case brings us to one of the most famous maritime disruptions in the modern history, the Ever Given grounding in the Suez Canal. This was an event that quite literally broke the back of the world's trade, and it is the clearest real world example of how the delay exclusion in cargo insurance works. Let's walk through what happened. On March 2021, the vessel MV Ever Given, a 400 meters ultra large container vessel carrying 18,300 containers, ran aground in the Suez Canal. For 6 days, the vessel was stuck, and over 400 ships were stuck at either end of the canal, waiting for the Suez Canal blockage by Ever Given to be removed. Global trade was estimated to be halted at a rate of 9.6 billion US dollars every day, with total disruption exceeding $58 billion for the 6-day period. After the vessel was successfully refloated by the salvors, it was immediately detained by a Suez Canal Port Authority, who demanded claim payment of a staggering amount of 916.5 million US dollars. The vessel was held in captivity for 100 days during the negotiations, which was finally settled at a whopping amount of US dollars $540 million. And after that, the vessel was released after a total 106 days. General average paid, but delay losses not covered. The Egyptian authorities ultimately settled for $540 million, and because the vessel declared general average, every cargo owner whose containers were on board the vessel had to contribute towards the general average claim. Now, cargo insurers did step in and cover their clients' general average contributions. This is the standard covered under Institute Cargo Clauses A, and it helped cargo owners recover from their share of that $540 million settlement. However, and this is the critical part of the slide, cargo insurers did not cover any delay losses ever given resumed voyage only after 106 days, more than 3 months of delay. For cargo owners, goods missed markets, perishables deteriorated, supply contracts were breached, inventory shortages cascaded across global supply chains. But all of those losses had one thing in common: they were not covered under cargo insurance. And the reason is simple and embedded in every marine cargo insurance policy: the delay exclusion applies even if the delay is caused by an insured peril. It doesn't matter that the grounding was a physical damage, that the canal was blocked, or the general average was declared. Delay is equal to excluded, and that's always. So, for perishable, shelf life cargoes, it is recommended to negotiate and purchase additional insurance cover for any loss or damage to the cargo resulting from delay triggered by insured maritime perils under Institute Cargo Clause A, WAR, and SRCC clauses. Similarly, for project cargoes, it is recommended to avail delay in startup or advance loss of profits insurance, providing a robust financial protection against such eventualities. There is also a newer form of insurance called trade disruption insurance, which covers such kind of eventualities. Insurance is often erroneously treated by business corporates like a commodity. Go for the cheapest because it's all the same, or one size fits all. At times, even brokers risk to carry the same impression. A bespoke, well negotiated, and best understood coverage placed with strong rated expert underwriters often is not given much importance or priority. This casual approach often results into uninsured situations and financial losses for business corporates. Now we transition from case studies into the core message of this entire presentation. You must mind the insurance gaps. Mind the gap. Four major uninsured risks that companies must most commonly overlook. The first is sanction risk. Every marine cargo policy or every marine insurance policy, be it covering hull, machinery, charter's liability, P&I, contains the JCC or Joint Cargo Committee sanctions limitations and exclusion clause, which gives the insurers the right to decline any claim if paying the claim would expose them to sanctions. It means if a vessel touches a sanctioned port, if a cargo origin is misdeclared, if beneficial ownership links to a sanctioned party, if AIS manipulation raises suspicion, insurers may legally refuse to pay, even if the peril itself is normally covered. This is why involvement with shadow fleet, Russian trades, or Iranian trades can inadvertently invalidate policies. The second gap is cargo confiscation, a non war risk trigger. Most companies believe that if the cargo is seized or detained, their insurance will respond. That is not the case. Cargo confiscation is not covered unless it arises specifically from a war peril. And even then, insurers often argue that it is political or government action, not war. This means seizure by Iran, detention by Houthis, government expropriation, administrative confiscation, court ordered cargo seizures are all excluded from standard cargo and war risk insurance policies. This is exactly what we saw in the vessel MB Advantage suite of Chevron cargo case, a $57 million uninsured loss. Confiscation is only covered through political risk insurance, not marine cargo insurance. The third gap is a delay risk. Cargo insurance does not cover loss, damage, or expense caused by delay, even if the delay was caused by an insured risk. This is a contractual exclusion under Institute Cargo Clauses A, WAR, and SRCC clauses. The fourth and the final important gap is cyber risk. involving mainly GPS spoofing, jamming, interference. Marine cargo policies incorporate cyber risk exclusion endorsements. With rising GPS jamming in the Red Sea, this becomes a major gap. If a vessel grounds, deviates, collides, or suffers machinery damage due to GPS spoofing, cyber interference, or navigational system manipulation, most insurers may deny the claim unless an apt cyber endorsement is specifically purchased. The MSC Antonia grounding example shows this risk clearly. The key takeaway is even with full marine insurance, companies remain exposed to sanctions, cargo confiscation, delay, and cyber risks. Understanding these four categories and purchasing the appropriate extensions or separate policies is essential for anyone shipping through Red Sea, Hormuz, or conflict sensitive regions. We now transition from the case studies into practical, actionable guidance based on everything we have covered so far. These are the key prudential learnings companies must adopt in the current environment. Firstly, do not assume your insurance covers all risks. Many companies, even multinationals, assume their marine cargo and war risk insurance policies are foolproof. The case studies we saw show the opposite. You must review policy wordings in detail and never rely on assumptions. Conduct a formal prudential review and in writing. Every policy of insurance, be it cargo, war, hull, P&I, must be reviewed with the insurer and broker in writing, especially before entering high-risk navigational zones. If underwriters do not confirm coverage in writing, assume it is not covered and suitably avoid the route or vessel if the vessel is not ISCS classed and not entered into with IGP&I club. Secondly, do not assume big corporations have robust cover. Even large, sophisticated global companies often have insurance gaps in their supply chain because policies may be outdated, endorsements are missing, war risk, especially political risk insurance cover, is not activated, sanctions checks are incomplete, or delay coverage is misunderstood. Size does not guarantee adequate protection. And the third important point is that the devil lies in the detail. So review your insurance contracts to verify its aptness, comprehensiveness, and adequacy to best ensure your supply chain's exposures in a bespoke fashion based on best practices. Fourthly, ensure you have a war and SRCC cover when transiting high risk areas in Gulf, Middle East, Indian Ocean, Black Sea, etc. This may sound obvious, but the MV Rubymar, MV Eternity Sea, and multiple shadow fleet casualties showed us one thing clearly. Many vessels still enter the Red Sea, Gulf of Aden, and Indian Ocean without confirmed war risk coverage. Insurers must approve the coverage and endorse the policy. You need to verify this. If war risk cover is missing, every other part of the insurance chain fails. Cargo, P&I, hull and machinery, charters liability, everything. A single uninsured missile strike or drone attack can bankrupt an operator. Fifth important point is obtain written confirmation of insurance cover directly from the insurer, not from the broker alone, not from an agent, directly from the underwriter and in writing. Sixth, know your vessel. Ensure that the vessel is classed by International Association of Classification Societies, entered with an international group of P&I club member, has hull, machinery, and war risk insurance covered by a well-rated and reputed insurer, and has a specific insurance confirmation for the proposed voyage if involving high-risk navigation zone, especially for war risk insurance coverage. You must also verify ownership transparency, no shell or shadow fleet links, AIS history and trading patterns, detect deceptive practices. You need to also verify previous detentions or deficiencies. If the vessel is a shadow ship, uninsured, outdated, or AIS manipulating, simply walk away immediately. This step alone could have prevented multiple losses in 2024-25. Seventh, know your voyage. Just as important as knowing the vessel is knowing the route itself. Confirm whether the vessel will pass through sanctioned areas, example Iranian waters, or excluded high risk navigation zones such as Southern Red Sea, Bab-el-Mandeb, Gulf of Aden? If yes, then additional war risk insurance must be purchased, otherwise, all claims may be denied. A voyage is only as safe as the route it takes. Last two important points is that for time sensitive cargo requires insurance extensions for delay. This is often overlooked. Unlike ICCA, war and SRCC, loss caused by delay is excluded even if the loss due to delay is by an insured peril. This means perishables, pharmaceuticals, food items, temperature sensitive goods, market price dependent commodities are not protected if delay occurs due to a missile strike, grounding, detention, salvage rerouting, or congestion. If your cargo's value is time dependent, you must procure delay or deterioration extensions or the claim will be denied. And finally, for high valued cargoes, especially oil and gas, commodities, automotives, it is recommended for cargo owners and traders to consider buying a full fledged political risk insurance to ensure full cover for confiscation and other political risks traditionally excluded or not covered under Institute Cargo Clauses A, War, and SRCC clauses. Finally, remember, supply chain ends when you, as a seller, receive payment from your customer. Credit risk is top priority. And today, in a highly volatile, uncertain, and complex and ambiguous world, a true VUCA environment, credit risk is the most underestimated exposure. No matter how well you protect your cargo, your voyage, or your vessel, if your buyer defaults, faces insolvency, political disruption, or payment blockages, the entire commercial value of the shipment is lost. In 2024-25, we saw rising corporate insolvencies, geopolitical payment interruptions, liquidity tightening across many markets, and domino effects where one major customer's failure causes downstream supply failures. Risk management doesn't end at the port, it ends where money is in your bank. That is why credit insurance protection, monitoring buyer creditworthiness, and country or political risks must be integrated into supply chain planning, not treated as an afterthought. The thoughts echoed by the CEOs and chief economists of leading global trade credit insurers, Allianz Trade, Atradius, and Coface, warn that the business environment is more volatile than at any time in recent memory. Protectionism and tariffs are rising again. Geopolitical crises are causing cash flow strains, and corporate bankruptcies are accelerating. In 2024, 474 large companies went bankrupt globally, and insolvency projections show this trend increasing into 2025. The risk is not isolated to any region. Europe is struggling with slow growth. Asia is exposed to supply chain shocks. Middle Eastern and African firms face political or payment disruptions. The Americas are dealing with inflation and tightening credit. These quotes reminds us that non-payment risk is now mainstream. Even strong companies can fail unexpectedly, and every supplier can experience a domino effect if a major buyer defaults. This provides the macroeconomic foundation for why trade credit insurance protection is indispensable. Protect your trade receivables with credit insurance. It offers up to 90% indemnification, that is, up to 90% coverage of your outstanding invoices if defaulted by your customers. Credit insurance offers a comprehensive financial protection against commercial risks if your customer goes insolvent or delays payment beyond 180 days. We call it as a protracted default. It also provides a protection against a spectrum of political risks such as government moratorium, transfer delay, discharge of debt, war, export license cancellation, and public buyer default. Some credit insurance policy also extends the cover to include payment defaults triggered by natural disasters or act of court perils and contract frustration events. Additionally, trade credit insurers also offer credit intelligence and monitoring services on 24/7 365 basis and debt collection services across the globe, facilitating effective debt recoveries and collections for delayed, defaulted and restructured debts. In a world where 85% of global trade is conducted on credit terms and receivables form up to 65% of current assets. Trade credit insurance transforms credit risk into a controlled insurable exposure. The key takeaway: cargo protection covers the shipment, credit insurance protects the payment. Without both, global trade is vulnerable. Credit insurers offer credit intelligence service on a real time basis. They monitor over 295 million companies on a real time basis using financial and payment behaviors, press reports, investigations, ownership changes, debt structures, covenant breaches, management changes, credit pressures, sectoral cross risk, and most importantly, insured exposures monitoring. This deep intelligence enables insurers to give businesses early warnings long before a default occurs. It isn't just about paying claims, it's about preventing losses through actionable insights. This is what allows companies to make smarter, safer credit decisions, especially in today's turbulent markets. US dollar 4.5 trillion of global trade secured using credit insurance. This shows the scale of trade credit insurance as a global financial instrument. As of January 2025, over $4.5 trillion worth of global trade was protected using credit insurance. That is 76% of global factoring volumes was protected by credit insurance, meaning trade credit insurance is now a core component of trade finance, supply chain financing, receivables discounting, and banking credit collateral. Banks rely on credit insurance to extend financing, suppliers rely on credit insurance to extend payment terms, and exporters rely on credit insurance to penetrate new markets. In short, trade credit insurance has become one of the pillars of global trade protection and liquidity catalyst. US dollar $4.9 billion in claim paid, supporting global commerce. This reinforces why trade credit insurance is not only important, it is effective. In 2025, trade credit insurers paid 4.9 billion US dollars in claims, enabling thousands of companies to survive bad insolvencies, geopolitical disruptions, and payment defaults. These claims prevented layoffs, bankruptcies, supply chain collapses, and working capital crises. Trade credit insurance doesn't just reimburse loss, it keeps global commerce flowing. Ladies and gentlemen, as we close this session, the key message across the entire presentation is simple. Global trade is entering a new era, one defined by geopolitical conflict, sanctions complexities, cyber threats, uninsured vessels, and financial instability. Today we saw how the Red Sea and Hormuz crisis, the rise of shadow fleet, war risk exclusions, sanctions clauses, delay exclusions, vessel age and maintenance failures, and growing global insolvencies are exposing companies to risks far beyond what traditional marine insurance was designed to handle. The takeaway is this: risk management today is no longer only about protecting the cargo, it's about protecting the voyage, the vessel, the trade receivables, and ultimately the cash flow for your business. The companies that will thrive in 2025 and beyond are those that verify insurance at source, conduct deep know your vessel due diligence, purchase war and political risk insurance covers proactively, avoid shadow vessels, strengthen sanction compliance, and secure trade payments through trade credit insurance solutions. Because your supply chain only ends when you get paid, and in today's world, that payment is far from guaranteed. Thank you for your time, your attention, and your commitment to strengthening global trade resilience. I look forward to your questions and discussion. Thank you very much.